Okay, good evening, guys. So today is the third day of uh, the advanced taxation session organized by ACCA Pakistan. The purpose of this session is to help you guys to uh, understand the type of questions that you're going to get at the exam and the areas that can be tested in your September exam. So here, that is why we call it Practice to Pass seminar session organized by ACCA Pakistan. So anyway, as I mentioned within the last 2 days, here you are required to practice questions on your own because here during this time period, I have 2 hours and 45 minutes excluding the break time period. So within that time period, I'm trying to explain the main areas that can be tested at the exam. So within the last 2 days, I was trying to explain main areas that can be tested with regard to inheritance tax and capital gains tax. So today, I'm going to discuss about employment income. Employment income. Now, before starting the session, now if you have missed the last two sessions that I conducted on inheritance tax and CGT, ACCA Pakistan will share the recorded session soon, so you can contact them to get more details with regard to that. And every day we have uploaded, for each day we have uploaded certain resources that are required for the relevant session that we conduct on that particular day. Likewise, today also I have uploaded certain documents with regard to employment income and some of the questions that you can practice to pass the exams on this particular area along with the answers. So you can go through the answers also. First, try to attempt those questions as homework and then compare your answers with the model answers that you have been given. And at the same time, yes, now I just received a message from ACCA Pakistan. So they're saying the last two sessions are already uploaded. If I'm not mistaken, you need to go to ACCA Pakistan website, and from that you will be able to download the previous two sessions. So here for today's lesson, I have uploaded PowerPoint presentation on employment income, and then income tax and administration questions and answers that you can attempt as homework. Then the other thing is there are certain articles written by your examiner with regard to different areas. So I have uploaded those technical articles written by your examiner as well. So if you go through all these things, you can have a perfect understanding with regard to the main areas of your syllabus, and accordingly you will be able to face the exam with confidence. So now I'm sharing the presentation slides with you guys. So it's on employment income. Now, as I said, the last 2 days we discussed about inheritance tax and capital gains tax. There you get separate questions from those two areas, and most of the time when they say capital tax implications, there you have to deal with both IHT and CGT implications. So those two areas you have to study together. Likewise, today I'm going to discuss about employment income. Now, this is something that comes under individual income tax computation. This is something that comes under individual income tax computation. And tomorrow I will be discussing the tax implications pertaining to unincorporated businesses, such as sole traders and partnerships, sole traders and partnerships. Now, today's topic and tomorrow's topic can be tested in one question. because both are pertaining to individual income tax computation. One of the main sources of income of an individual is employment income. The other one is trading income or business income. So we need to understand the different types of tax implications stemming from employment income and self-employment income. We should be able to make a comparison. And finally, on Friday, we'll be discussing about corporation tax. So let's start today's topic on employment income. Now, what is this employment income? So there can be confusions. There can be confusions when you're identifying whether a particular income is employment income or self-employment income. Because when it comes to certain people, it's not that straightforward. Sometimes they are working for certain organizations. However, we are not sure whether they're actually working as employees or independent contractors who are working for that particular organization. Now, for an example, if you take the education industry, there are full-time lecturers, there are part-time lecturers. So full-time lecturers, you may be able to recognize them as employees of the institution. However, if you have part-time lecturers who conduct lectures maybe during weekends, so then it's not easy for you to figure out whether they're actually employees or self-employed people. Even in a hospital, there are doctors who are working, but some doctors actually work for more than one hospital. At the same time, there are certain doctors, we call them in-house doctors, they are only attached to that particular hospital. Now, in that case, they may be treated as employees, but what about the other doctors who visit more than one hospital? So can we consider them as employees? May not be able to consider them as employees, so you will have to put them into the category of self-employed people. So you can see it's not a straightforward situation. Even though it looks straightforward, practically it's a complex situation. However, we need to simplify this complex situation anyhow. That is because the tax principles, the tax rules pertaining to employment and self-employment income are different from each other. So they are not the same. And the tax implications are completely different depending on whether the source of income is employment income or trading income or self-employment income. Because when it comes to employment income, there is something called national insurance contribution. And even for self-employment income, we have national insurance contribution. But the classes of NICs that we are using for employment income and self-employment income are different from each other. So that for us to clarify those things, we have to proper understanding what kind of income that must be considered as employment income. So for that purpose, we are using different factors. So here there's an acronym that you have been given. I mean, it's not essential for you to memorize these things, but just get a rough idea. How do you actually determine whether a particular individual should be treated as an employee or self-employed person? So these are the factors that we are using: number of hours, fixed hours, and long period. But you know, self-employed people, they don't have fixed and long period. Integration, that means the job that they are performing, whether it's an integral part of the business. So likewise, there are several factors that they are using. You can just go through it, but it's not essential for you to memorize them. Anyway, now, then the next situation that we need to consider here is that how to calculate the assessable employment income. How to calculate the assessable employment income. Now, when it comes to casual workers, lower level employees, it's not that difficult to calculate the employment income because their employment income mainly consists of the salary received, mainly consists of the salary that they have received. But at the higher level, the employment income of an individual consists of several items. That means that is why we call it, they're entitled to a remuneration package. They're entitled to a remuneration package. Now, this remuneration package consists of different types of benefits. It is not restricted or limited to salary. So there you may have bonuses, commissions, and other benefits. So when you say other benefits, mostly non-cash benefits such as motor car benefit, fuel benefit, then accommodation benefit, sometimes gift of asset benefit, use of asset benefit, beneficial loan benefit. Likewise, there are several benefits that are given to an employee, and most of these benefits are non-cash benefits. In that case, under employment income, we have to use certain rules, some special rules to calculate the monetary value of those benefits. Because if it is a non-cash benefit, there is no exact value. For an example, car benefit. You have been given the opportunity to use a motor car for your private purposes provided by your employer. Now you enjoy a benefit, but you need to give a monetary value for that benefit. So for that purpose, we are using some special rules to calculate the answer. And then there can be excess mileage allowance. Now we have something called approved mileage allowance. You know how it works, the approved mileage allowance. Approved mileage allowance is actually not a benefit, it is an allowable expenditure. How does it work? If an employee uses his own motor car for business purposes, for employment purposes, in that case, he is entitled to claim a particular amount as an allowable expenditure. Now, for an example, assume you have done 12,000 miles. You have done 12,000 miles for the purpose of employment, for the purpose of employer's business. So you have used your own car. It's not a car provided by your employer. It is your own car that you have used for the purpose of employment or for the business of the employer. Assume it is 12,000 miles. Assume it's 12,000 miles. Now, in that case, you are permitted to claim an allowable expenditure. You are permitted to claim a deduction against your employment income. How do you calculate it? For the first 10,000 miles, for the first 10,000 miles, you take 45 pence. You take 45 pence per mile. 45 pence per mile. So there you get 4,500 pounds. You get 4,500 pounds. Then anything in excess of 10,000 pounds. So here you get 2,000 miles. So per mile, 25 pence. 25 pence. So there you get 500. So here in total, you can claim 5,000 as an allowable deduction against your employment income. We call it approved mileage allowance. But there can be situations where the employer makes a contribution when you're using your own motor car for his business purposes. So there can be a situation where the employer makes a contribution when the employee is using his motor car for the purpose of employment or for the work of the employer. Assume the employer has paid 4,500. Your approved mileage allowance is 5,000. However, the employer has made a contribution to that approved mileage allowance 4,500. So in that case, your actual deduction available against your employment income is 500 pounds. It is 500 pounds in that case. Your approved mileage is 5,000 pounds. However, the employer has made a contribution of 4,500. So you have actually spent only 500 extra. That's how you have to assume. So that is an allowable deduction against your employment income. What if the employer has paid more than the approved mileage allowance? What if the employer has paid more than the approved mileage allowance? Approved mileage allowance. So approved, that means you are entitled to claim a deduction of 5,000. However, your employer has made a contribution exceeding the approved mileage allowance. That means you have got extra. The employer has got extra 1,000 pounds. Now, this should be treated as a benefit. This is what we call excess mileage allowance. Approved mileage allowance is 5,000. However, the employer has made a contribution of 6,000 in excess of the approved mileage allowance. This 1,000 should be treated as a benefit on which he should pay taxes on his own. So that is what we call excess mileage allowance computation. Okay. Then from this, you are permitted to deduct certain expenditure. Basically, any expenditure incurred wholly, exclusively, and necessarily for the purpose of employment, you can deduct. Expenditure incurred, you can see wholly. W means wholly, exclusively, and necessarily for the purpose of employment, you are permitted to deduct it. However, in addition to those expenditure, employees are permitted to deduct certain items which are allowed by a particular statute issued by the Parliament of the United Kingdom. We call them statutory deductions. That means by law, they are permitted to deduct certain expenditure. In that case, they are not going to consider whether it's wholly and exclusively and necessarily incurred for the purpose of employment. The law permits you to deduct certain expenditure. They have identified certain types of expenditure that you can deduct when you're calculating employment income. We call them statutory deductions. So what are those statutory deductions? If you have made, if the employee has made a contribution to his occupational pension scheme, So you know there are two types of pension schemes. One is occupational pension scheme. The other one is personal pension scheme. Occupational pension scheme and personal pension scheme. Now, occupational pension scheme is something applicable only to employees. However, if you take personal pension schemes, now in the exam, they have tested the area pensions as well. They have asked certain questions from this area. However, it's a small area, but it's worth going through that small chapter as well for the exam. So anyway, only an employee can make a contribution to an occupational pension scheme, but any other individual can make contributions to personal pension schemes. So here we are referring to employees' contribution to employers, that means pension scheme that is an occupational pension scheme. In addition to that, now if you are working as an accountant, then if you are a member of a particular accountancy body such as ACCA or Institute of Chartered Accountants of Pakistan, or the relevant the accountancy body in that particular country, you're a member. In that case, you have to make a subscription. So if you're functioning as an accountant, the subscription that you have paid to an accountancy body is an allowable deduction because it is related to your employment. So subscription, which has some kind of a bearing with the job that you perform, in that case, you are permitted to claim it as an allowable deduction. In addition to that, there can be situations where employees make contributions from their salaries every month to a charity. Example, every month from your salary, you make a contribution to a charity. So we call them payroll deductions. Payroll deductions. So you can deduct that amount as well. And little while ago, I explained the approved mileage allowance. So I took the example, approved mileage allowance. So where the approved mileage allowance was £5,000. So if the employer does not make any contribution, no contribution at all by the employer, then the full amount 5,000 you can claim as an allowable deduction, or else assume the approved mileage is 5,000, but the employer makes a contribution of only 4,000. So there is a deficit of £1,000 that you can claim as a deduction. If the employer pays more than the mileage allowance, then we have excess mileage allowance. It becomes a benefit. But if the employer pays less than the approved mileage allowance, the deficit, the difference, you can claim as an allowable deduction. And there are share option schemes and share incentive schemes provided to employees. There are certain share option schemes and share incentive plans available to employees. Now, there are certain companies where they offer shares to their employees. They give the option to the employees to purchase shares. We call them share option plans. In addition to that, sometimes employees are given shares free of charge or for a particular amount. We call them share incentive plans. Share incentive plans, right? So anyway, share option schemes like CSOP, company share option plans. Then we have save as you earn. So anyway, if the employee is permitted to buy shares in that company through a share incentive plan, SIP means share incentive plan, introduced by the company, the cost or the money paid by the employee to purchase shares under share incentive plan can be deducted against his employment income. So if the employee has paid money to purchase shares under a share incentive plan introduced by his employer, in that case, the cost incurred by the employee to purchase shares under share incentive plan is an allowable deduction here. Then you get an answer, and if there is any redundancy payments. What do you mean by redundancy payment? Now, this will not occur all the time, but if now, you know a lot of people lost their jobs during this COVID-19 time period. There were reductions in salaries. Now, that is not a redundancy. However, some people lost their jobs. Now, the main purpose for that was the organizations did not have funds to keep those employees, so they were made redundant. So that means you're losing, you here lose your job. However, the employer is required to pay certain compensation, certain payments to the employees who have been made redundant. So the company or the employer must make certain payments to the employees who have been made redundant. So we call them redundancy payments. Now there are some special rules pertaining to redundancy payments. That is, certain payments made when an employee is made redundant are completely exempt from income tax. Completely exempt from income tax. We call it statutory redundancy payment. Now, the law requires an employer to pay compensation when they make an employee made redundant. We call them statutory redundancy payments. Those are normally exempt from income tax. But in addition to that, if the employer pays further redundancy payment in such situation, in that situation, if you want to make additional payment other than the statutory redundancy payment, you can claim a partial exemption. That means up to £30,000 will be exempt. Up to £30,000 of the redundancy payments will be exempt. Anything in excess will become chargeable. However, when you are calculating this £30,000, if you have received any statutory redundancy payment, you must deduct that amount. For an example, take a situation like this. Assume the statutory redundancy payment, statutory redundancy payment, say it's £8,000. Say it's £8,000. In addition to that, you have made an ex gratia payment. Ex gratia payment means a payment made in gratitude. The employer has no contractual obligation to pay that amount, and that is not the custom of making the payment, but in gratitude, the employer has decided to pay an extra amount. I'll call it ex gratia payment. Ex gratia payment. Ex gratia payment. So say that ex gratia payment is £40,000. £40,000. Now the question is, now the statutory redundancy payment of 8,000 is exempt. That is definitely exempt. This is exempt. Now there's an additional payment of 40,000, ex gratia payment of 40,000. Out of that, part of the amount will be exempt. Part of the amount will be exempt. Now the question is, what is the part of the amount that will be exempt? Now up to 30,000 it will be exempt. However, this 30,000 limit must be reduced by any statutory payment made. Now here there is a statutory payment made of £8,000. So this 30,000 should be reduced by £8,000. Should be reduced by £8,000. Then there's a balance of 20,000, £22,000. So out of this 40,000, 22,000 will be exempt, and the balance 18,000 will become chargeable. So out of 40,000, 22,000 will be exempt, balance 18,000 will become chargeable. That's the situation with regard to redundancy payments. And then you calculate the amount, add it to the employment income. Okay? And we are going to discuss about the share option plans also. And if it is not a tax, there are two types of share option plans. One is tax advantage share option plans and the non-tax advantage share option plans. Those days we used to call it approved share option plans and unapproved share option plans. So here we are referring to a share option plan which is not approved. We call them non-tax advantage share option plans. Now in that situation, when you exercise a non-tax advantage share option plan, there can be certain amounts that will be taxed on you as employment income. So if you have any amount like that, you add everything, then you get the assessable employment income. All right. Now, as I mentioned, if the employee is paid a salary, there's no complication. salary will become his employment income. Salary will become his employment income. However, if the employee is provided with, non-cash benefits, if the employee is provided with non-cash benefits, then you need to ascertain the taxable benefit of the employee, taxable benefit of the employee. But some benefits are there, they are exempt from income tax. They're exempt from income tax. They're exempt from income tax. But some of the benefits are chargeable benefits. Now, there is a collection of exempt benefits. You can go through them leisurely, but I will here mainly focus on the benefits which are taxed on the employee. So there, the most commonly tested ones are car benefit. You know, when you are calculating the car benefit, we are using a special formula. You're given the list price of the car and you should multiply the list price by the approved percentage. I'll come to that later. So anyway, there's a special formula. Likewise, if you are provided with fuel for your private journeys, then the fuel benefit is also there. And sometimes you are provided with accommodation for your private use, private accommodation. In that case, you get an accommodation benefit. Then sometimes the employer allows you to use certain assets owned by the employer. We call it use of asset benefit. Sometimes the employer may gift you assets for you to use it for private purposes. You call it gift of asset benefit. Sometimes the employer lends you money at an interest rate below the official rate of interest of 2.5%, or else without charging any interest whatsoever. So then it should be treated as employment benefit. We call them beneficial loan benefit. So likewise, there are certain benefits which are chargeable on the employee, and those also must be added to the employment income of the individual. However, for those benefits, if the employee also makes a contribution, assume you're using a car provided to you by the employee for your private purposes. Assume the employment benefit calculated is 20,000 pounds. The car benefit is 20,000 pounds when you calculate it. However, the benefit does not come free of charge. Assume the employee also makes a contribution for the benefit. That means employer is charging a particular amount from the employee when he is using the car for his private journeys. So in that case, if you have any contribution made by the employee, say in this instance 5,000 pounds, employee's contribution towards this benefit is 5,000 pounds. So then you deduct that amount, you get an answer 15,000 pounds. 15,000 pounds. So this is the assessable benefit. Fair enough, because 20,000 cannot become the full benefit, because as the employee, you also make a contribution of 5,000 pounds. In that case, your assessable benefit should be 15,000 pounds. However, there's one exception where you are not permitted to deduct your contribution as an employee. What is that benefit? Fuel benefit. When it comes to fuel benefit, remember, unless the employee pays the full fuel cost, partial claims are not permitted for you to deduct against the fuel benefit. So when it comes to fuel benefit, we use all or nothing basis. All or nothing basis. So if the employee has made a contribution to his private fuel, unless he pays for the full private fuel cost, it cannot be considered as a deduction against the benefit like this. So remember, normally employees' contributions can be deducted when you're calculating the benefit, except for the fuel benefit, because there we use all or nothing basis. Either you pay for all your private fuel, then you are permitted to deduct. But if you do that, there's no actual benefit on you for you to pay taxes. Or if you make a partial payment, that amount is not a permissible deduction against your employment income. All right. Then yes, you are absolutely right, Ali. Ali is saying if he pays for all, there wouldn't be any benefit. You are absolutely correct, Ali, because if you have paid for your private, if you have paid for the fuel used for your private journeys, that means you bear your own petrol. You pay for your own petrol. You pay for your own fuel. So in that case, it will not result in any benefit. So that's how it works. So you're right. So these are the ways that you calculate the taxable amount depending on the nature of the benefit. So when it comes to cash vouchers, if you are provided with cash vouchers, in that case, so the cash value should be treated as a taxable amount. If it is a non-cash voucher, say you are provided with a voucher where you can claim health insurance, or where you can claim, you can use the voucher to use gym facilities. In that case, it's a non-cash voucher. You can get a service. You're not. It's not a cash voucher. You can get a service for that amount. In that case, the benefit that is accessible on you as the employee is the cost incurred by your employer. To provide the non-cash voucher to you, the employer has paid a certain cost. His cost becomes your benefit. Whatever the cost incurred by the employer to provide the non-cash vouchers becomes the taxable amount on the employee. Credit cards, normally there is a limit. Now you're not charged up to that limit. What matters is during a particular tax year, if you have utilized the credit card to purchase certain items for your private purposes, and that amount will become taxed on you, but you don't have to pay taxes on the interest or any card charges. So what matters is what is the value of the goods and services that you have purchased for private use, and that amount should be treated as a taxable amount. Then payment by an employer of an employee's liability. Example, the employer pays employee's home telephone. In that case, the amount paid by the employer becomes an assessable benefit on the employee. Okay. Then living accommodation. So there is a special computation that we are doing actually. There's a basic charge and there is an additional charge if it is treated as expensive accommodation, where you have incurred more than £75,000 to acquire the property. Then you call it expensive accommodation. Then there is a special additional charge. Otherwise, there is a basic charge on which you will be taxed. All right. So you can see this is how you calculate the living accommodation benefit. The basic charge is, it doesn't matter whether it's expensive accommodation or not. If you're provided with accommodation for your private use, then the employee is subject to tax on the basic charge. What is the basic charge? It is the higher of the annual value of the property or rent paid by the employer. You don't have to worry about the annual value. That amount will be provided to you at the exam. Then, if the property is not owned by the employer, if the property is not owned by the company, then what will happen? You will be given a rented property. So you will be permitted to use a rented property, and the rent relevant to the property will be paid by the employer. So from the annual value of the from the two values, that is the annual value of the property, and you take the rent paid by the employer on behalf of the employee, from the two amounts, you take the higher value. You take the higher value, and on which the employee must pay taxes. That is what we call basic charge. In addition to that, if the property falls within the definition of expensive accommodation, then there will be an additional charge as well. But here you must remember, this additional charge will arise. This additional charge will arise only if the additional charge will arise only if the accommodation is owned by the employer. If it is a rented property, then the property is not owned by the employer, then you cannot consider expensive accommodation. For you to consider whether it's expensive accommodation or not, the property must be owned by the employer, because to determine whether the accommodation falls within the ambit of expensive accommodation or not, you need to look at the cost incurred by the employer to purchase the property. So if it is a rented property, obviously the employer does not own the property. The employer has not bought the property. Therefore, we cannot find out the cost incurred by the employer to purchase the property. So expensive accommodation will only arise if the property is owned by the employer, and if it is a rented property, remember, there will not be any additional charge. So how do you decide whether it's expensive accommodation or not? If the employer has spent more than £75,000 to buy the property or to own the property, then we call it expensive accommodation. So say you have spent £100,000 to purchase the property. That means you have spent more than £75,000. Therefore, it is an expensive accommodation. If it is an expensive accommodation, you need to calculate the additional benefit provided to the employee. How do you calculate that amount? You take the cost and you deduct £75,000, which is a fixed figure. You take the difference in excess of 75,000. That difference you multiply by the official rate of interest. It's given to you in the tax table. Currently, it's 2.5% for the tax year 2019-20. The official rate of interest is 2.5%. So you take the difference, multiply by the official rate of interest, and then you get the accommodation benefit, which is expensive accommodation benefit. It's an additional charge other than this basic charge. So this is how you calculate it. Okay. Then ancillary benefits. That means other benefits. Other benefits are, now when you're provided with accommodation, sometimes you may be provided with furniture as well. So you are provided with furnished accommodation. So Nazia is asking the question, if employer owns a property but less than 75,000, what should be the implication? So that's, I told you, then you will be having only the basic charge. Since it's not expensive accommodation, you don't have to do the additional charge computation. Then you will be having only the basic charge. So coming back to what I was explaining. So along with the house or accommodation, assume that you are provided with furniture as well. So there the employee is permitted to use furniture. The employee is permitted to use furniture. Then when you are using furniture and other equipments, plant and machinery, you need to calculate the taxable benefit on the use of furniture as well. So if the employer has given you any asset for the private use of the employee, you have to calculate something called use of asset benefit. How do you calculate the use of asset benefit? This is the formula that we are using. You take the market value when furniture or the asset was first provided. What is the market value when the asset was first provided to the employee? Say it's 10,000 pounds or just say 1,000 pounds. So the market value of the asset is 1,000 pounds when it was first provided to the employee. On that, per annum, per tax year, for a period of 12 months, you take 20%. So if you have not used the asset throughout the tax year, you need to time a portion. But if you have used the asset throughout the tax year from 6th of April to 5th of April 2019-20, in that case, you get a benefit equivalent to 20% of the market value when it was first provided. So you get 200 pounds, which is an assessable benefit, And sometimes the employer may pay your living expenses as well. When you live in a house, you have to pay telephone, electricity, your internet, your gas, so utility bill payments. So even if those living expenses are also borne by your employer, you don't have to pay. Then the cost incurred by the employer becomes an assessable benefit on you. Quite understandable. Then for the house, you will have to pay council taxes. We call it rates. It's a tax that you have to pay to the municipal council, to the local authority when you are using a house. Even though you own the property, you have to pay a tax to the relevant local authority, maybe urban council or municipal council or county council. So you have to pay that tax amount. And if that amount is also paid by the employer, then it becomes a benefit on the employee as well. How much will be taxed on the employee? Whatever the cost incurred by the employer will be taxed on the employee as a taxable benefit. Okay? Now, when you're calculating the additional charge here, due to expensive accommodation, you actually use the cost. However, if you have provided accommodation to the employee after 6 years from the date of purchase of the house, assume you bought the house in June 2012, you bought the house in June 2012. But you provided accommodation to the employee for the first time in, say, June 2019. You bought it in June 2012, but it was given to the employee for the first time only in June 2019, that is after 6 years' time. You spent, say, 100,000 in June 2012, 100,000 in June 2012 to buy the property. That is your cost. However, it was given to the employee for the first time after 6 years from the date of purchase, in that case, to calculate the expensive accommodation benefit or the additional charge, then in that case, you are not using the cost. Then you are not using the cost. Instead, you should use the market value available at the time of providing it to the employee for the first time. So it was first provided to the employee in June 2019. So you must use the market value available at that time. So if the market value is 150,000, then you should ignore 100,000 and you must do this computation using the market value when it was first provided to the employee. But for you to use the market value, it should be provided to the employee after 6 years from the date of purchase. From the date of purchase, it was first provided to the employee after 6 years only. Then substitute market value instead of this cost and calculate the assessable benefit. Okay, right. Now, what you have to remember here is if the accommodation is job related, then actually it is an exempt benefit. Then there's no basic charge, no expensive accommodation, no council tax accessible on you. But if the living expenses are incurred by the employer, you need to calculate as normal. You must pay taxes on that. However, it cannot exceed 10% of other employment income. So anyway, what you have to remember here is if it is job related accommodation, then it is an exempt benefit. What do you mean by job related accommodation? For an example, if you are a security officer, then accommodation will anyway, it will be provided to you. Accommodation will be provided to you, not for your private use, because that's the only way he can perform his duty, because the security guard has to stay there. So accommodation is provided to him because his job is looking after the premises. So of course, you have to provide accommodation. That is an example for job related accommodation. And most of the time when it comes to hotel industry, the employees who are working in a hotel, they are also provided with accommodation because they're supposed to work 24/7 or they're supposed to work according to shift basis. So it will be difficult for the hotel management to do their operations if the employees have to travel most of the time. So they can get late, but you have to serve your customers. So in that case, they are provided with accommodation within the hotel premises. That is also another example for job related accommodation. And also, if say a minister, the president, now they are also provided with official residence. We don't call it private residence, we call it official residence. So once the job is done, you have to return the house. Again, job related, in that case, it is an exempt benefit. Now, it's always better to be familiar with this car benefit and the fuel benefit. Be familiar with the car benefit and the fuel benefit, and that calculation is based on the carbon dioxide emission of the vehicle. And further, it depends on the type of fuel used in the car, whether it's petrol driven car or diesel driven car. And the car benefit depends on the list price as well as the carbon dioxide emission of the car. When it comes to vans, then there is a fixed amount. If the employee is provided with a van for his private use, there's an assessable benefit of 3,430 per annum on him. If the employer provides fuel to the van, if the fuel for van for his private journeys, then it gives you a fixed benefit of 655 pounds per annum. If you have not enjoyed the benefit throughout the tax year, then you need to time apportion it. Then beneficial loan benefit. This benefit will arise if the employer has provided you with a loan below the official rate of interest. Below the official rate of interest. For an example, the employer has given you a loan of 20,000 pounds at an interest rate of 1%. It's not the loan which gives you the benefit, it is the reduced interest charge gives you the benefit. So the official rate of interest, as I mentioned previously, is 2.5%. However, you're paying only 1%. Therefore, you get a benefit at the rate of 1.5%. Official rate of interest is 2.5%, but you are paying only 1%. So you get a benefit of 1.5%. So 20,000 into 1.5%. There are two methods to calculate the answer. We call it the average method and the precise method. Under the average method, what we do is we take the opening loan balance and the closing loan balance, and that you divide by 2 to get the average loan balance, and then you have to multiply that answer by 1.5% that you get, then you get the beneficial loan benefit. So for the exam, please go through car and fuel benefit and this beneficial loan benefit. If an asset is given to you for your private use, as we discussed previously, you have to calculate a benefit of 20% on the market value of the asset when it was first provided. Okay? Now you can see this is how you calculate the car benefit and the private fuel benefit. So if it is the car benefit, if it is the car benefit, this is the formula that we are using. List price into the appropriate percentage, and you need to time apportion it if you have not used the benefit throughout the tax year. List price, you don't have to worry about it. The amount will be given to you at the exam. Okay. However, there can be situations where to purchase the motor car, the employee also has made a contribution. Say the value of the list price of the motor car is 20,000 pounds. And to purchase this, the employee also has made a contribution of 6,000 pounds. Car is owned by the employer. The majority contribution is made by the employer, but they have got the employee also to make a contribution. So assume that the employee's contribution is 6,000 pounds. In that case, you can deduct this you can deduct your contribution towards the purchase of the motor car, but up to a maximum deduction of £5,000. Now here you have made a contribution of £6,000, but you're only permitted to deduct up to a maximum of £5,000. So though your contribution is £6,000, here you can deduct only £5,000. So then the car benefit should be calculated only on £15,000. £15,000. Okay. Then the next question is how to calculate the percentage, appropriate percentage, and that depends on whether it's a petrol-driven car or diesel-driven car. However, now there is a new type of a diesel engine, which meets RDE2 standards. Now, if the question say it's a diesel-driven car, but it meets the RDE2 standard, in that case, it should be treated as a normal petrol-driven car. It should be treated as a normal petrol-driven car. With regard to the, now they are asking certain questions. I will share my number towards the end of the session. And with regard to the previous dates dues, you need to check with the administration, because that is completely done by the administrator. My job is to deliver the lecture based on the materials that have been uploaded to the system. So what you can do is you can contact ACCA Pakistan and ask for the materials. Okay, right. So anyway, if the diesel-driven car meets RDE2 standards, then you need to consider it as a normal petrol-driven car. Because here, the carbon dioxide emission will be more if it is a diesel engine car. Petrol-driven cars, the carbon dioxide emission is less. Diesel engines emit a lot of carbon dioxide. But in the United Kingdom now, there are diesel engine motor cars which meets the special criteria or standard called RDE2 standard. Then their emission, the carbon dioxide emission is also low like a petrol-driven car. So anyway, this, I mean, it's a technical thing, but at the exam, they will not go this far. But remember, if it is a normal petrol-driven car and a normal diesel-driven car, normal-driven car and petrol-driven car, in that case, there will be a percentage difference. Normally, at the exam, you are given the relevant rates. However, they are with regard to petrol-driven cars. So when it comes to a petrol-driven car, if it is exactly 95 grams per kilometer, it will be 23%. But if it is more than 95 grams per kilometer, it's like this. If it is 50 grams or less, the fixed rate for a petrol-driven car is 16%. If the question says it is a diesel-driven car, to the petrol percentage always at 4%, then you get the diesel percentage. So if the question says it's a diesel-driven car, but in the tax table, you get only the rates for a petrol-driven car. But there won't be any problem. You just take the percentage applicable to a petrol-driven car and at 4%, then you get the appropriate percentage for a diesel-driven car. Diesel-driven car. Okay? Diesel-driven car. Then if the carbon dioxide emission is between 51 and 75 grams per kilometer, 51 to 75 grams per kilometer. In that case, the percentage is 19%. If it is diesel, it should be 24%. Yes, you just need to add extra 4% here. Okay. Then if it is, one second, guys. Yeah, this is correct. So you need to add to whatever the percentage you add. No, this should be 23% actually. I'm sorry. This should be 23%, not 24%. There's a mistake here. So 19% at 4%, you get 23%. If it is 76 to 94 grams per kilometer, this should be corrected, 23%. Okay. And here, if the carbon dioxide emission is 76 to 94 grams per kilometer, petrol driven 22, diesel driven at 4%, then it will be 26%. All right. So just add 4% to whatever the petrol percentage that you have been given. Now, if it is exactly 95 grams per kilometer, if it is a petrol driven car, then it's 23%. 23%. Then if it is diesel driven, 27%. That's fine. But if the carbon dioxide emission is more than 95 grams per kilometer, if the carbon dioxide emission is more than 95 grams per kilometer, then the computation must be done in this particular way. Anything in excess of 95 grams per kilometer, for every 5 grams per kilometer, you have to add 1%. So assume the carbon dioxide emission is 119 grams per kilometer, 119 grams per kilometer. What you should do is, you should round it down to the nearest multiple of 5. You should round it down to the nearest multiple of 5. You have to round it down. Round it down. So when you round it down, it is 115 grams per kilometer. Always round it down. So for 95, the appropriate percentage for a petrol-driven car is 23%. Anything in excess of 95, for every 5 grams per kilometer, you need to add 1%. Round it down, then it's 115. Take the difference between 115 and 95. So there you get 20. Divided by 5, you get 4. So then the appropriate percentage is 27%. If it is a diesel-driven car, just add 4% to this answer, then it will be 31%. Then the other thing that you need to remember, petrol or diesel, it cannot exceed the maximum rate of 37%. Petrol or diesel, the percentage cannot exceed 37%. So when you calculate the answer, if you get an answer exceeding 37%, you forget about that and take 37% as the appropriate percentage. Okay. Now I explained that because it is important for the exam, and knowing the computation will be important. Then, if the employer provides you with private fuel for your private journeys, then that will also result in a benefit. But to calculate that, what you should do is, you should use the same percentage that you calculated here and apply it on 24,100, which is a fixed figure given to you at the exam. 24,100. To that amount, you apply the relevant percentage calculated for the purpose of car benefit, and you need to time apportion it if the benefit is not enjoyed throughout the tax year. So as I mentioned, if the car meets the RDE2 standards, then forget about the fact that it's a diesel engine car. Treat it as a normal petrol driven car. So the percentage that you get for a petrol driven car can be used as it is if the car meets RDE2 standards. Okay, I hope it's clear. Right. Then this is another area. So within the next 20 minutes available before the break, I will explain the balance part as well. This is another area that will be tested at the exam. So the tax implications pertaining to share option schemes. Share option schemes is extremely important for the exam. Now, the outcome depends on whether it is an approved share option scheme. Now we call it tax advantage share option scheme, or else unapproved or non-tax advantage share option scheme. Now, what a share option is? What is a share option? A share option is a situation where the company permits an individual, here in this instance an employee, to purchase shares of the company on a future date at a price which has been fixed today. So they give you a fixed price today, and on a future date, you can buy shares of the company on the price that was given to you today. Say, a share option was granted on the 10th of grant of the option, say 1st of January 2012, 1st January 2018. So on this date, the option was granted. That means you're not going to buy shares on this date. It gives you the option to purchase shares on a future date at a particular price determined today. Say the price determined today is £2. £2. That means after another 3 years' time, or after a particular time period, maybe 1 year, 2 years, or 3 years, or even it can be 7 years, 10 years. So after a particular time period, you can exercise the option if you want to. It's not mandatory for you to use the option, but if you want, you can exercise the option, and after another 3 years' time, you can purchase shares at the price of £2, notwithstanding the market price available at that time. At the time of exercising the option, the share value would have increased. Assume that the share value is £5. At the time of exercise, assume the market value of the share is £5. At the time of exercising the option, the market value of the share is £5. But still, you don't have to pay £5 to buy these shares. You can exercise the option and you can buy the share at the price that was determined when the option was granted to you on the 1st of January 2018. Now, most of the time, this is the market value available at the time of granting the option. Most of the time, this is the market value that is available at the time of granting the option, that is 1st of January 2018. Okay, right. So here, assume you decided to exercise the option, say on the 1st of January 2020, after 2 years' time, you have decided to exercise the option when the market price is £5. Now remember, approved or unapproved, at the time of granting the option, nothing happens. You are just merely given the option to buy your shares on a future date. You haven't done anything on this date. You have been given the right to purchase shares. That's all. So when the right was granted, that does not result in any tax implication, notwithstanding whether it's approved or not unapproved share option scheme. So at the time of granting the option, no tax implication. And here, according to my example, on the 1st of January 2020, you have decided to exercise the option and purchase shares at the price of £2. However, if it is an approved share option scheme, at the time of exercising the option also, no tax implications. No tax implications. If it is an approved share option scheme, the benefit that you get is when you exercise the option, you don't have to pay taxes on that if it is approved. If it is approved. However, if it is an EMI share option scheme, now under the next slide, I'm going to explain the different types of the share option schemes available. One is EMI, Enterprise Management Investment Share Option Scheme. Yeah. If the share option scheme is an EMI share option scheme, most of the time this is the share option scheme that they have tested. If it is a EMI share option scheme, the option can be granted at any amount, but if it is below the market value that existed at the time of granting the option, assume the market value is £2 here at the time of granting the option, but assume the option was granted not at the market value that was available at the time of granting the option, but assume it was granted at 180 below the market value at a discounted price. If that is the case, if it is an EMI share option scheme, then you need to take the difference between £2 and 180. You need to take the difference between £2 because that was the market value available at the time of granting the option, but it was given to you at a discounted price with a discount of 20 pence. With a discount of 20 pence, in that case, you will have to pay income tax. You will have to pay income tax as an employment benefit on this difference. However, if you have granted the option at the market value that was existed at the time of granting the option, not at a discounted price, then no tax implications will arise if it is an approved share option scheme. All right. So in general, if assuming that you have granted the option at the market value available at the time of granting the option, if it is approved, no tax implications. However, if it is an unapproved one, in that case, there will be a benefit assessable on you as an employment benefit, on which you will have to pay both income tax and national insurance contribution. So if it is an unapproved share option scheme, example, 1st January 2018, the option was granted £2. This is the same as the market value, £2. You exercise the option on the 1st of January 2020. When the market value was £5. So the market, if you are going to buy from the market, you have to pay £5. But since you can now exercise the option, you can purchase it at £2. Market value at the time of exercise date is £5. But now you can purchase it at £2. Forget about this cost of option, because sometimes to get the option, you will have to pay a small amount. So option is granted at a particular amount. So if you guys have done financial management, so you would have learned this. When they are granting an option also, you will have to pay a particular amount. But to simplify the situation, for you to understand the concept, assume there's no cost of option, assume that it is zero. So you are now buying a share worth of £5 by spending £2. So there you get a benefit of £3, isn't it? You have given the option to purchase a share at £2 when it is actually worth £5. So it gives you a benefit of £3. This should be treated as an assessable or taxable employment benefit. And the employee must pay taxes on this benefit. If it is an unapproved share option scheme, that you don't have to do if it is an approved one. So the important thing that you need to remember, this £3 is not treated as a chargeable gain. It is treated as an employment benefit because the option was given to you. Option is given to you since you are an employee of the company, therefore it should be treated as an employment benefit. Then you have to pay income tax. What about national insurance contribution? Now, national insurance contribution on employment benefit. I'll explain that also because that is a straightforward area, but an important area for your exams. So there are two types of NICs charged on employment income. One is class 1. One is class 1. The other one is class 1A. Class 1 and class 1A. Class 1A. Now, class 1 is the national insurance contribution charged on cash and cash equivalent earnings. Class 1 is calculated on cash and cash equivalent earnings paid to the employee. There, on cash and cash equivalent earnings, both the employee and the employer must make contribution. Both the employee and the employer must make contributions. Okay, employee and employer. And the way that you have to calculate the employee's contribution and the employer's contribution, you don't have to worry about it. The rates are given to you at the exam. The relevant thresholds are also given to you at the exam. However, class 1A is calculated on non-cash benefits such as motor car benefit, fuel benefit, beneficial loan benefit, gift of asset benefit, use of asset benefit and all. So class 1A is calculated on non-cash benefits, and this must be paid only by the employer. This must be paid only by the employer. This must be paid by the employer only. So the national insurance contribution that you have to pay on this £3 employment benefit, there is a benefit on the employee, £3. So the national insurance contribution that you have to pay on this £3,000 depends on whether it's a cash benefit or non-cash benefit. It depends on whether it's a cash benefit or non-cash benefit. If this £3 is a cash benefit, then both the employee and the employer must pay national insurance contribution on this £3,000. Not only the employee also should pay national insurance contribution on this £3,000 if it is a cash benefit. But if it is a non-cash benefit, then the national insurance contribution applicable is class 1A only. If it is a non-cash benefit, then applicable national insurance contribution is class 1A, and it should be paid by the employer only. Employee has no obligation. Then the next question that arises is, how do we decide whether it's a cash benefit or non-cash benefit? Simple. If the share is a listed share, if the share that you have bought under the share option scheme provided to you, if it is a listed share, then you can easily sell that share in the London Stock Exchange. If it is a listed share, if it is a quoted share, you can easily sell that share in the London Stock Exchange. So the liquidity is high. So you can easily convert into cash. Therefore, it should be treated as a cash benefit. But if the share that you have bought is from an unquoted company, in that case, you can't easily convert into cash. Liquidity of the asset is low. Therefore, it should be treated as a non-cash benefit. In that case, only the employer must pay class 1A NIC in that situation. Okay, so that's how both income tax and NIC will be there. Then later, now you exercise the option and bought the share at £5. So you bought the share at £2. Then later, say on the 10th of January 2020, after 10 days, you're selling the share in the open market, say for £6 now, for £6. Now the share price is £6 on the 10th. Here, as cost of shares, if it is an unapproved one, you should put £5. That is the market value that was available here. Cost of the share equals market value when exercised. It's not your actual cost. You actually bought it for £2. But the market value that was available at the time of exercise was £5. So you deduct £5, and then there is a chargeable gain of £1, which will be subject to CGT, capital gains tax, not income tax. That £1 will be subject to CGT. So here there was a benefit of £3, and here benefit of £1. Here benefit of 3, here benefit of £1. £3 was subject to income tax and NIC, £1 was subject to CGT. But if it is an approved share option scheme, in that case, here at the time of exercise, no problem. But assume you sell the share like this for £6. How much you should deduct as your cost of shares? In this instance, the actual cost that you incurred to purchase the share should be deducted. You bought the share actually for £2. Then here, the chargeable gain will be £4. So on this £4, you will have to pay CGT. You will have to pay CGT. Now you can see here the benefit is £4 and the full benefit is treated as a chargeable gain and pay CGT. Here also the total benefit is £4, 3 plus 1. But out of 4, on 3, we had to pay income tax. On the balance £1, we had to pay CGT. Which is more beneficial? I told you earlier also, paying CGT is more beneficial than paying income tax, because the CGT rates are low, 10% and 20% maximum. And if it falls within the ambit of entrepreneurs relief, you have to pay only at 10% all the time. But here, this £3 is charged as employment income subject to income tax, perhaps national insurance contribution also if it is treated as a cash benefit. In that case, you have to pay at the rates of 20, 40 and 45%. Only £1 will be taxed under the CGT regime. So you can see this share option scheme, this has been tested at the exam, is an area that you need to go through. And since time is out to explain theory, since I have to give you the break now, After that, as usual, we are going to discuss some questions. So I have to end my theory explanation right now. But please go through the balance part of the presentation as well. And there are three types of share option schemes available. Out of this, EMI is a very important one, relevant for the exam. Comp and share option plans are also there. And there is something called save as you earn. So I wish I had more time to explain these things, but it's important for you to go through this table and identify the differences between each and every share option scheme. Importantly, this EMI share option scheme more than SAE and CSOP. CSOP also they have tested, but these two are the most important ones. Okay, so let's take a break now. Let's take a break now for 15 minutes, and we'll start the session again after 15 minutes time. There, I will be discussing some questions with you guys. So let's take a short break and meet again in another 15 minutes time. Okay, guys, let's start. And must tell you, so we are doing this session like every day, 3 hours allocated. So you would appreciate that we are not in a position to cover each and everything. So I only can assist you and how to face the exam and the areas that are important for the exam. So and within this 3 hours time period, when you exclude the break, also there are 15 to 20 minutes. So then we are left with only 2 hours and 45 minutes. So in that within that time period, I try to maintain a balance between both theory and practical questions that you get at the exam, right? Therefore, straight away, now let me look at some theory questions. I'll start with question number 3. Actually, that is based on September-December 2015 paper. So this is the question. First, we'll read the required part. Excuse me. You should ignore value-added tax for parts A and B. Explain with the aid of calculations which of the two alternatives of providing financial assistance for home to work travel is most cost efficient for Corinne and HESOP Limited. Explain with the aid of calculations the corp tax implications for HESOP Limited. So here I'm not going to explain this part because it's something to do with corp tax. Then the part C is about actually value-added tax. So let's deal with part A here. So what are these alternatives provided? Okay, it's here. So ESOP Limited wishes to provide assistance with home to work travel cost for Corinne, who is an employee, and also requires advice on the corp tax implications of the purchase of a short lease and the value-added tax implications of the sale of a warehouse. So it's a summary of the type of questions that they're going to ask at the end of the question. So it's a UK resident trading company, prepares accounts to 31st December each year, registered for value-added tax, leased a factory on the 1st of February 2020. Then Corinne is resident and domiciled in the UK. Is resident and domiciled in the UK, is an employee of ESOP Limited who works only at the company's head office. Earns an annual salary of 55,000 from ESOP Limited and has no other source of income. So there's an annual salary of 55,000 pounds. So the company's assistance with home to work travel cost. ESOP Limited is considering two alternatives to provide assistance with Corinne's home to work travel cost. Provision of a motorcycle. Provision of a motorcycle. ESOP Limited will provide Corinne with a leased motorcycle for traveling from home to work. Provision of the leased motorcycle, including fuel, will cost ESOP Limited 3,160 per annum. This will give rise to an annual taxable benefit of 3,160 for Corinne. Corinne will incur no additional travel or parking cost in respect of his home to work travel. Right. Alternative 2, payment towards the cost of driving and provision of parking place. ESOP Limited will reimburse Corinne for the cost of driving his own car to work up to an amount of 2,240. Can you remember we did an approved mileage allowance computation? So he's using his own car to work up to an amount of 2,240 each year. Corin estimates that his annual cost of driving home to work is 2,820. Additionally, his op limited will pay AB Parking Limited 920 per year for a car parking space for Corin near the head office. So we need to calculate the assessable benefits in this situation. Okay. Okay. Now, there are two parts to this question. Explain with the aid of calculations which of the two alternatives for providing financial assistance for home to work travel is most cost efficient for Corinne and for the company. So let's first look at the benefit that arises to Corinne, not the benefit, the cost. Okay, let's look at the first one. So cost to Corinne. Cost to Corinne. Alternative one. Now, what we have to look at is what is the cost incurred by Corinne if the company goes for alternative one. So the company will provide Corinne with a lease motor car for traveling from home to work. Provision of the lease motorcycle, including fuel, will cost his op limited 3,160 per annum. Now that cost is borne by his op limited, not by Corinne. So we are trying to find out the cost to Corinne first. This will give rise to an annual taxable benefit of 3,160 for Corinne. So the cost is incurred by the company, but that gives a benefit to Corinne as an employee on which Corinne is supposed to pay taxes. So tax is also a cost. So now Corinne is receiving a benefit of 3,150. But on that 3,160 benefit, Corinne has to pay income tax, which is a cost to Corinne. Now, what is the rate applicable? The question says Corinne earns an annual salary of £55,000. And this is the only source of income that Corinne is having. Therefore, when you deduct the personal allowance, which is 12,500, the taxable income would be 42,500. So that means currently he's a higher rate taxpayer. Therefore, if he receives any benefit Therefore, if he receives any benefit other than this 42,500, other than this 55,000, other than this 55,000, as a higher rate taxpayer, he will have to pay taxes at the rate of 40%. So that means there is a tax cost of, there's a tax cost of 1,264. So if you go for the alternative one, Corinne will have to bear a cost of 1,264 as he receives a benefit of 3,160 on which he has to pay taxes at the rate of 40% as he is a higher rate taxpayer. So this is the cost for him if you go for alternative one. So you can see it's not that complicated. You just need to understand the question. Then what if we go for alternative two? Alternative two. Payment towards the cost of driving and provisional parking place. Hisop Limited will reimburse Corinne for the cost of driving his own car to work up to an amount of 2,240 each year. Corinne estimates that he has an annual cost for driving from home to work. Now, one thing you have to be very careful here. In this situation, we cannot use the approved mileage allowance. We cannot use the approved mileage allowance computation. Why can't we use the approved mileage allowance computation here? Why? The reason is approved mileage allowance computation is only applicable when an employee uses his motor car for the purpose of employment or for the business of the employer only. Now then you will ask the question, isn't it the case here? Isn't it a situation where he uses his motor car to travel from home to work and work from work to home? No. Remember, commutation or commuting. Commuting means traveling from home to work and returning from work to home. You call it commuting. So commuting is not treated as business traveling. It is treated as private traveling. So because of that, yes, Matusha, you are right. So traveling from home to work and returning from work to home, it is not treated as business traveling because anyway you have to travel every day if you have been employed. So you have to, ideas you have to bear that cost on your own. So in that case, approved mileage allowance computation is not applicable because that mileage is considered as private traveling, not as business traveling. Therefore, forget the approved mileage allowance computation. Instead, look at his annual cost. So he believes that there is an annual cost of 2,820, annual cost of 2,820. But he does not have to bear the full cost. That is because out of that, the company is reimbursing 2,240. So there's an amount reimbursed, which is 2,240, which gives an actual cost of 580. So there's 580 cost on you. Then additionally, Hisop Limited will pay parking 920, per year for parking space. Now that parking space cost is also borne by the company. However, remember the parking space cost borne by the company is an exempt benefit. So this 920 paid by the company on behalf of an employee is an exempt benefit. Therefore, you don't have to pay income tax on that. However, this 2,240 cost incurred by the company is an assessable benefit. So for the purpose of traveling from home to work and coming back from work to home, coming back home from work, for that, the company is incurring a cost of 2,240, and this is the cash amount received. It gives him a benefit on which he has to pay income tax. Now, on this cash received, which is an assessable benefit. Now, parking cost is an exempt benefit. So, parking cost, it is an exempt benefit. It is an exempt benefit. The cash received amount 2,240. It is an assessable benefit on which you have to pay taxes. Now, you'd be really careful. Yes, you have to pay taxes at the rate of 40%. At the rate of 40%. But do not forget there is something else also that Corinne will have to pay on this 2,240. What is that? National insurance contribution. National insurance contribution. Why does Corinne have to pay national insurance contribution on this 2,240? Because it is a cash and cash equivalent benefit. Before the break, I explained both the employee and the employer must pay national insurance contribution on cash and cash equivalent benefits. Now, he already has an employment income salary of 55,000 pounds. 55,000 pounds. As the employee, on this 55,000 pounds, he is supposed to pay national insurance contribution. He's supposed to pay national insurance contribution. However, first 8,632, look at the tax table. You can extract these figures from the tax table. It's given. So first 8,632 is not subject to national insurance contribution. Then the balance up to 50,000 pounds. Balance up to 50,000 pounds subject to the rate 12%. Subject to the rate 12%. Subject to the rate 12%. Anything in excess of 50,000 is subject to 2%. This is his current situation. Now, on top of this 55,000, now he's receiving a cash amount of 2,240. On top of this 55,000, he is now receiving a cash amount of 2,240. He's receiving a cash amount of 2,240. In that case, on this, since you have exceeded 50,000 already, anything in excess of 50,000, you have to pay national insurance contribution of 2%. Therefore, on this cash amount received also, Corinne will have to pay 2% as national insurance contribution. So she will have to pay income tax at the rate of 40% on this 2,240, and at the same time, she will have to pay another 2% as national insurance contribution. Both are going to be cost for that person. So 2,240 into 42%. So here you get an answer of 941. You get an answer of 941. So this gives you the total cost if you go for the this gives you the total cost if you go for the second alternative. Second alternative. So that is 1,521. So from Corinne's point of view, which alternative is more beneficial? Alternative 1 is more beneficial for Corinne because her cost will be less if she goes for alternative 1. So provision of the motorcycle is the most beneficial one to Corinne, as the cost that must be incurred by Corinne is less here than alternative 2. I hope it's clear. Now, on this, there is no national insurance contribution because it is a non-cash benefit. You are giving a motorbike. A motorbike is a non-cash benefit. If it is a non-cash benefit, the national insurance contribution that is applicable is not class 1 but class 1A. Class 1A is a national insurance contribution that must be made only by the employer, not by the employee, and no national insurance contribution on the employee. That is why we did not calculate NIC on this, because it's a non-cash benefit which is subject to class 1A, which must be borne by the employer. Now we'll look at the next part of the question. Cost to Sept Limited. Yep. Cost to Sept Limited. So alternative 1. Let's see. From the company's point of view, what is their cost? They are paying 2,200 and, sorry, how much? 3,160. Will provide Corinne with a leased motorcycle for traveling from home to work. The cost is borne by Sept Limited, 3,160. So under alternative 1, cost, lease cost, $3,160. Now, as I mentioned a little while ago, this is a cost incurred by the employer and a benefit provided to the employee, Corinne, here. And this is a non-cash benefit. And this is a non-cash benefit. Therefore, on this 3,160, employer must pay class 1A NIC. Class 1A NIC. How does class 1 NIC works? Whatever the non-cash benefit, on that the employer must pay 13.8%. 13.8% as national insurance contribution. So here 3,160 into 13.8%. Again, the percentage is given to you at the exam. 436. So here, $3,596 is the total cost. $3,596 is the total cost to ESOP Limited. Then alternative 2, there the company is paying reimbursed cost. You can see the question is not that difficult, just a matter of understanding. The reimbursed cost is 2,240. 2,240. Parking cost is an exempt income to Corinne on which she does not have to pay taxes, but still it is a cost that must be borne by ESOP Limited. So parking cost is part of the cost of the company. How much is that? 900 and parking cost. How much? 920. 920. In addition to that, on the benefit provided, here we calculated Class 1 NIC on the cash amount provided. So 2,240 was a benefit provided to, was a cash benefit. 2,240 is a cash benefit provided to Corinne, on which both Corinne and the company should pay Class 1 NIC. So when the employer pays, NICs, how does it work? When the employer pays, again you can look at the tax table. First 8,632, 0%. Anything in excess of 8,632, anything in excess of 8,632, the employer must pay 13.8%. 13.8%. Thirteen point 8%. Anything in excess of 8,632. Okay. So there's no upper limit like for the employee. That's the difference between Class 1 NIC contribution on the employee and the employer. When you're doing the computation for an employee, 8,632 to 50,000 is at the rate of 12%. Anything in excess of 50,000 at the rate of 2%. But if you are the employer who's paying Class 1 NIC on the same amount, first 8,632 is at the 0 rate, but anything in excess of 8,632 always at 13.8%. Accordingly, in this situation, on the reimbursed cost, parking cost is exempt, but on the reimbursed cost, employer must pay Class 1 NIC. Employer must pay Class 1 NIC. that is on 2,240 at the rate of 13.8%. 13.8%. So 2,240 into 13.8%. 3,469 is the cost. Now, which one is the lowest cost? Now, for the employer, alternative two is the most beneficial one. That is paying towards the cost of driving. But for the employee, it's different. So on cash benefits, as I mentioned, if you were listening carefully, you would have realized on cash benefits, both the employee and the employer must pay class 1 NIC. Please go through a national insurance contribution. So those are basics. And one more thing, you don't pay national insurance contribution on exempt benefits. So parking cost is an exempt benefit. On exempt benefit, there's no NIC applicable. So if the benefit is an exempt benefit, no one has to pay national insurance contribution. So parking cost is an exempt benefit. So let's look at another question. Yeah, there is a share option scheme question, so we will answer test your understanding 4 also. Not test your understanding 4, question number 4 also. That question is based on September-December 2016. September-December 2016. So let's first read the required part. Compare and contrast the tax implications of both the acquisition and disposal of the shares. In Methley Limited, if Simon acquires the shares through a tax advantage company share option scheme, that is, here they are using CSOP, or alternatively as an award of shares, that means gift of shares. You're not required to comment on any national insurance contribution implications. Now, an important thing to remember at the exam, that is, if the question says explain the income tax implications, even though they have not specifically mentioned, you are required to explain national insurance contribution implications as well. National insurance contribution implications as well, unless question specifically states that ignore the national insurance contribution. Now in this question, the question specifically states to ignore the national insurance contribution implications, then you can ignore it. Prepare calculations to determine which of the two proposed benefits the company motor car or the loan will result in the lower overall income tax for Chris? Now, the third one is actually from tax administration. So first, we will look at both part A and part B. Okay. So let's read the question. Your firm has been asked to provide advice to Methley Limited, a closed company. A closed company, we know a closed company is a company which is controlled by 5 or less than 5 shareholders of the company. In respect of the share or provision of share incentives, a motor car and an interest-free loan to employees. So the first two parts are about actually employment income, whereas the third part is about how a non-UK domicile employee should be taxed when they are using remittance basis. Anyway, Methley Limited is a UK resident company which is a closed company. Methley is a UK resident trading, Simon share incentives. Simon is a director of Methley Limited and owns 20% of his ordinary shares. Methley Limited intends to provide Simon with shares worth of 25,000 in the form of either free shares or share options. If it is free shares, he doesn't have to pay anything. If it is a share option, he will have to pay something, but most of the time below the market price. The free shares would be issued in June 2021. The share option would be issued under a tax advantage company share option scheme in June 2021, and Simon would exercise the option in October 2025. In either case, Simon will sell the shares in December 2027. So the option will be granted in June 2021. He will exercise the option in October 2025, and the shares that he bought from the option by exercising the option, he will sell in December 2027. Simon is a higher rate taxpayer. Chris is employed by Methley Limited and owns 10% of its ordinary shares. Chris is employed by Methley Limited and owns, okay, first let's look at question number 1, that is for Simon. So let's look at the answer now. So part A, Simon. First one, acquisition of shares. Acquisition of shares. Now, since it's a tax advantage share option scheme, since it's a tax advantage share option scheme, tax advantage share option scheme, tax advantage share option scheme, no tax. Now, there are 3 stages: acquisition of shares, acquisition of shares from a share option scheme, share option scheme. Either there will be an award of shares or you will have to purchase from the share option scheme. Share option scheme. Then at the time of granting, at the time of granting. No income tax. No income tax. No income tax. Then at the time of exercise, no income tax. No income tax. Because a tax advantage. Then at the time of disposal, there will be a chargeable gain. There will be a chargeable gain subject to CGT. Subject to CGT. Okay. So this is what will happen if the shares are given to me by way of a share option. Since it's a approved share option scheme, we call it CSOP here. There are different types of share option schemes. So they have tested CSOPs. So in that case, at the time of granting the option, that was in June 2021, no income tax implications. When he exercised in October 2025, no income tax implications. But if he decides to sell those shares in December 2027, there will be a tax liability, but not under income tax. It will be treated as a chargeable gain and will be subject to CGT. If there is a loss, it will be an allowable loss. But what if the shares are given to him as free shares, awarded free shares worth of how much? 25,000 pounds. So if the shares are given to you not by way of an option, straight away given to you free of charge. Free of charge, then free of charge worth of 25,000 pounds. On this, Simon will have to pay income taxes at the rate of 40% because Simon is a higher rate taxpayer according to the question. So if you are given shares under a share option scheme, even at the time of disposal, you will have to pay not income tax but CGT only. But if you are awarded free shares, in that case, the cost, the value of the shares, 25,000, should be treated as a benefit provided to Simon, a taxable benefit on which he will have to pay taxes at the rate of 40% as he is a higher rate taxpayer. So in that case, he will have to pay an income tax of 10,000 pounds on the shares awarded to him. So those are the tax implications, both income tax and other tax implications on Simon. So let's look at B also. It's about Chris, employed in Medplay Limited and owns 10% of its ordinary shares, has been offered the sole use of a company motor car or alternatively a loan to enable him to purchase the same motor car himself, receives a salary from the company of 60,000 pounds and receives dividend of 2,000 pounds each year. So there are two alternatives, either to use the company motor car or to buy his own motor car, but using a loan given to him by the company. All right? Okay. Now, alternative 1. Metli Limited would purchase the motor car on the 1st of October 2020 for £9,600, which is 800 less than the list price. The motor car would immediately be made available to Chris exclusively for his private use. The motor car has carbon dioxide emission of 80 grams per kilometer and is diesel powered. The car meets the RDE2 standard. The car meets, in this question, they say it meets the RDE2 standard. Chris would contribute 700 per year towards the private use of the motor car. Chris pays for all of his diesel himself. So that means no fuel benefit, but there is a motor car benefit. But towards the benefit, he contributes £700. Metli Limited will give the motor car to Chris after 3 years when its market value is expected to be £6,600. Alternative 2, providing a loan, Metli Limited would provide Chris with an interest-free loan of 9,600 on 1st of October 2020. The loan would be written off in 3 years' time. Okay, so let's answer the question. And kindly note this, I am actually doing a revision session. So because sometimes I get questions. So actually the time must be allocated fully only to discuss questions. But as a support, I have allocated the first session of the lecture to explain parts of the theory. But the whole purpose of conducting this seminar is to practice questions. That's why we call it practice to pass. So it's about doing some revision, not explaining theory during this session, right? But still I have allocated some time because you need to have some idea about the main areas of the syllabus. However, the most important thing that we intend to do during this session is to go through questions and answer questions. So by now, we assume that you have gone through your theory and you have got relevant knowledge. And here I'm actually trying to explain how to apply your theoretical knowledge to a given situation. So here, prepare calculations to determine which of the two proposed benefit, the company motor car or a loan, will result in the, okay, so straight away, we'll get the answer. Provision of the motor car. So basically, you need to calculate the car benefit. So you can remember, during the theory session, we learned how to calculate the car benefit. For the purpose of now, when you're sitting for the exam, remember, you need to gain subject knowledge, but ultimately, whether you are going to get through the exam depends on the number of questions that you practice. How many questions you practice. Because it's a very vast syllabus and they are not going to test each and everything that you have in the syllabus. Only the important areas will be tested at the exam. So to find out the important areas, you need to look at the revision questions. You need to look at the past paper questions to find out the most important areas. If you look at the textbook, only you have the whole syllabus, but 100% they cannot test. Only 5 to 10% they will be able to test at the exam. So it's always wiser for you to identify the most examinable areas. The only way that you can figure out by looking at the questions, by answering the questions, then you get an idea. Okay, these are the main areas that are tested under employment income, inheritance tax, and CGT. Then when you are studying, spend more time to learn those important parts of each and every topic. Okay, so how do you calculate the car benefit? The car benefit, you calculate car benefit list price into the appropriate percentage. Appropriate percentage. Okay, so that's how you calculate the answer. Now, here, what is the list price? What is the list price? You have bought the car for 9,600. That's not the important figure. The list price is the important figure, which is 800 less than the list price. So add 800 to get the list price, which is 10,400 pounds. Then the relevant percentage, Now here, the carbon dioxide emission is 80 grams per kilometer, but it is diesel powered. However, it meets the RDE2 standards. Then I told you, even though it's a diesel powered car, if it meets the RDE2 standard, then it should be treated as a petrol driven car. That means it is similar to a petrol driven car. Therefore, you should use the appropriate percentage used for a petrol driven car. So you can see if the carbon dioxide emission is between 76 grams per kilometer to 94 grams per kilometer, if the carbon dioxide emission is between 76 to 94, the percentage applicable is 22% to a petrol driven car. The same percentage you have to apply to a diesel powered car, which meets RDE2 standard. So the appropriate percentage is 22%, because the carbon dioxide is between 76 to 94 grams per kilometer here. So now you can calculate the car benefit. You get the annual benefit actually. So 10,400 into 22%. This I extract from the tax table. So if the carbon dioxide emission is you get 2,288. So here, if the carbon dioxide emission is between 76 to 94 grams per kilometer, the relevant percentage is 22%. Petrol, similar to a petrol-driven car. Okay, 2,288 is the benefit. However, Chris would contribute 700 per year towards the private use of the motor car. prepare calculations to determine which of the two proposed benefit, the company motor car or the loan, will result in the lower overall income tax cost for Chris. So you need to calculate the income tax cost for Chris in this situation. From this, contribution by the employee less contribution by Chris, you can deduct. So the actual benefit that you get is 1,588. Yes, Salman, that you're right. So you need to deduct 700 pounds. So then you get 1,588. Okay. Further, this 5,000, okay. Methley Limited would give the motor car to Chris after 3 years when its market value is expected to be 3,600. So Methley Limited was purchased the motor car 1st of October and immediately be made available to Chris exclusively for his private use. You have to be a little careful here because in this situation, the car will be provided to him on the 1st of October 2020. 1st October 2020. 1st October 2020. So it was given to him for the first time during the tax year 2020-21. Then Chris would here this is important here, try to understand the question. Methley Limited would give the motor car to Chris after 3 years. So from 1st of October 2020, he will be able to use it for a period of 3 years until 30th September 2021, 22, 23. So for 3 years. So that means every year he receives a benefit of 1,588. Every year he receives a benefit of 1,588. So for 3 years he is going to enjoy this benefit. For 3 years he is going to enjoy the benefit. So the total benefit for 3 years, 1,588 into 3. Straight away I will get the answer. 1,588 into 3. 4,764. 4,764. Then Metro Limited will give the motor car to Chris after 3 years when its market value is expected to be 6,300. 6,300. That means the car is given to him free of charge. He doesn't have to pay anything. The car will be given to him free of charge after 3 years when the market value is 6,300. Therefore, he receives another benefit, gift of asset benefit. Gift of asset benefit here. He gets the car when the market value is 6,300. So he receives a total benefit of 11,064. He receives a total benefit of 11,064. So you can see has been offered the use of car, receives a salary from the company 60,000 and receive dividend of 22,000 each year. So that means he's a higher rate taxpayer. Therefore, income tax on benefits at the rate of 40%. So 11,064 into the rate of 40%. So you get 4,426. 4,426. So if he goes for the alternative one, where he is provided with a motor car purchased by the company and provided to him, and allowing him to use it for a period of 3 years, which gives him a total benefit of 4,764. And at the end of the 3 years, he gets the opportunity to receive the motor car to himself without paying anything. That gives him a benefit of 6,300, in total 11,064. Now here, I did not calculate the benefit for each and every tax year, because the objective of this computation is to find out the total income tax cost. They're not asking us to calculate the income tax liability for each tax year. They want us to find out. That's why you have to read the question carefully and accordingly answer the question. Yes, during this tax year, now he received the car on the 1st of October 2020, but he has not enjoyed the benefit throughout the tax year. But here we are not asked to calculate the income tax liability on the benefit for each tax year. What they're asking is, what if you accept the motor car given to you by the company, and what will be the total tax cost as a result of that? So whatever the tax year, at the end of the day, if he gets to use it for a period of 3 years, every year he receives a benefit of 1,588. These 3 years will fall into different tax years. That's a different story. But at the end of the day, he will enjoy this benefit for a period of 3 years. Each year he has a benefit of 1,588. So within the 3 years period, he will enjoy a benefit of 4,764. In addition to that, the car will be given to him free of charge when the market value is 6,300, gives another benefit after 3 years. So as a result of this alternative one, ultimately, Chris receives a benefit of 11,064, where he has to pay taxes at the rate of 40% as a higher rate taxpayer. Therefore, his income tax cost on the benefits received due to alternative one is 4,426. Then finally, to wind up the session, we need to calculate the income tax cost if he goes for alternative 2. Now, in alternative 2, what happens is, this alternative 1, Alternative 1. Then alternative 2. Metri Limited would provide Chris with an interest-free loan of 9,600 on 1st of October 2020. The loan would be written off in 3 years' time. Now, Chris, is he a shareholder of the company? No. He's not a shareholder of the company, because if he's a shareholder of the company, there are some special rules applicable to close companies when they lend money to its shareholders. But that is not applicable here. Chris is merely an employee of the company. Now, when a loan is provided to an employee interest-free, it provides a taxable benefit to the employee. We call it beneficial loan benefit. However, there's a concept called small loan exemption. Small loan exemption. What do you mean by small loan exemption? If the loan provided to the employee does not exceed £10,000 during the tax year, then the benefit is completely exempt. The benefit is completely exempt. So if the loan value does not exceed £10,000, you can claim small loan exemption. Though the loan is provided free of charge, you don't have to pay taxes on the benefit that you have received. Why? Because this falls within the small loan exemption. Okay? So here, small loan exemption is available as the loan amount does not exceed £10,000. Does not exceed £10,000. No taxable benefit. No taxable benefit. Now, here need to check okay, Chris is employed by Mithley Limited and owns 10% of his ordinary shares. Okay, so he's a shareholder as well. Now, this is something that we should learn under under corp taxes. If the company is a closed company, and if the company provides a loan to a shareholder of the company, then there are some special rules applicable. However, if the loan value does not exceed £10,000, that will not result in any taxable benefit. However, after 3 years' time, they have written off the loan. The written off the loan. At the time of written off, this 9,000 should be treated as 9,600 should be treated as a distribution. 9,600 should be treated as dividend income. So whether you are an employee or not, if the company has provided a loan to an employee as well as a shareholder of the company, and if the company is a closed company, then at the time of receiving the loan, employee is not subject to any tax. However, if the loan has been written off after some time, then that amount must be treated as dividend income, not as employment income. On this 9,600, he will have to pay taxes actually, income tax charge off. On this 9,600, you will have to pay taxes at the rate of 32.5% as a higher rate taxpayer, Now you might be thinking, can't I claim the dividend nil rate band? You cannot claim dividend nil rate band because you have already a dividend income of 2,000. So your 2,000 is covered by the dividend nil rate band. So this 9,600 should be treated as dividend income subject to the higher rate of 32.5%. So here 9,600 into 32.5%. So there you get a tax liability of 3,120. So if you look at the two costs, 4,426, here 3,120. So if you look at this situation, alternative 2 gives you a lower income tax cost on the employee. So try to understand this. This company is actually something to do with closed companies as well, something that you get under corp taxes. But here, these two are working, Simon and Chris are working as employees as well. So Simon, Chris are shareholders as well as employees of a closed company. If a closed company provides a loan to a shareholder as well as an employee, on the company, there is a special tax charge on the company at the rate of 32.5%. That I will explain under corp taxes. On the employee, when the loan is provided, there is no taxable benefit on the employee when the loan is granted, because you don't have to pay taxes on a loan. You pay income tax on income. If you have employment income, you pay tax. If you have trading income, you pay taxes, dividend, income tax. If you have interest income, you pay taxes. But when you obtain a loan, do you have to pay taxes? No. However, if you receive the loan from a company, HMRC is little suspicious about the payment, because in a closed company, the shareholders are in a position to manipulate the distributions to avoid taxes. Therefore, if the company is a closed company, some special rules are applicable. So if a closed company provides a loan to a shareholder, notwithstanding whether the shareholder is an employee or not, the company is subject to an immediate tax of 32.5%. However, there is no tax on the employee until such time the loan is written off. The loan is written off after 3 years, then it becomes an income distribution to this person, not as employment income, but as dividend income. Now, normally when you receive dividend income, £2,000 is subject to dividend nil rate ban. However, you can't apply the dividend nil rate ban because every year you anyway receive a dividend of 2,000. So as a higher rate taxpayer, on this 9,600, you have to pay taxes at the rate of 32.5%. 32.5%. All right. Then this loan is given to you free of interest. Now, if the loan is given free of interest, normally it gives a benefit to you either as an employee or non-employee. If you are an employee, the beneficial loan must be treated as employment income. But here, the loan amount granted is less than £2,000, which falls within the category of small loan exemption. Therefore, it is exempt from income tax. Hence, you don't have to calculate the beneficial loan benefit, but normally you have to calculate that benefit and pay income tax on that. Okay. So that's about that's the same. I mean, it's actually not enough. Within 3 years, you can't discuss not even 20 to 30% of the employment income. You get more, but I just wanted to give you some idea the type of questions that you can get at the exam. So let's stop at this point. But let me share my number because some of you have again asked for my number. So whatever the doubts that you can clarify with me by messaging me on this number. Okay. So let me type that number for you now. Okay. So tomorrow I'm going to discuss about unincorporated businesses. So the handouts will be shared, and as usual, first part of the session, I'll be discussing some parts of the theory, and then we'll be discussing some questions. So let's stop at this point. Until tomorrow, take care. Good night.